Welcome to today's webinar, which is our corporate finance debate for the Northern region. In this webinar, we're going to look at the M&A market for 2020, and we're also going to discuss how we see 2021. For those of you that don't know, my name is Phil Scott. I'm Director at FD Recruit, and I'm joined by 4 expert panelists who's going to be sharing their knowledge of working within the corporate finance market. I calculated earlier, we've got over 100 years combined experience between the panelists. So we're delighted to have everyone on board today. So here's the running order. We're going to go through a main set of pre-prepared questions, and then we're going to open up to questions from the audience. The audience questions, if you do want to ask the panelists a question, please put it in the chat box facility. I think Zoom does email everyone and tell you to email through, but we haven't got an eye on the inbox. So it's only the questions that appear in the chat box at the bottom of your screen that we're going to be running through at the end. So I'm going to make some introductions. We'll start with James Wild, partner for M&A and PE at RSM. Started with Baker Tilly, been in corporate finance for 18 years, all with the same organisation. James, you want to just give everyone an introduction to who you are and what's happening in your world at the minute?
Yeah, thank you, Phil. Yeah, so I'm an M&A partner at RSM, based in Manchester, kind of covering the Northwest. Been working from home like most people over the past, well, Christ, how long now? 9 months or so. Been in the office occasionally, but generally working from home. I think last time we did this, Phil, I was actually in my son's bedroom near his bunk bed, which I spent about 6 months, I think, next to before I realised I needed to upgrade that. And now I've moved to the children's playroom now, which is a good thing, better than it was before. But yeah, working from home. It's been really busy, and I'm sure we'll come on to that as a group in terms of talking about activity levels. But it's been a lot of hard work in the past few months as the activity levels have massively increased.
Great to hear you've been promoted within the household throughout the COVID from the bedroom to the spare room. So I'll go over to Roger Esler. Roger, owner and director at Dow Schofield Watts. Also director at PhD Equity Partners. Roger trained in audit, but for the last 28 years has been operating in corporate finance. And Roger, do you want to give us a quick overview of what's happening in your world at the minute?
Yeah, thanks, Bill. Well, I cover the Yorkshire North East region for DSW, having set the office up here about 9 years ago. So looking forward in 2021 to getting back out on the road and doing a bit more face-to-face work, really. But I mean, I think as James said, I think we've all actually learned how to work and function and get deals moving and over the line in this virtual world. So it's been quite an educational journey. But again, as I'm sure we'll talk about, I think there's a lot of activity out there in the market, and with our offices in the Northwest, Yorkshire, North East, London and Aberdeen, we're seeing quite a range of projects. So feeling very optimistic.
Great, thank you, Roger. Over to Nigel Barrett. Nigel is corporate finance partner at Hurst Accountants. 32 years I make it in corporate finance. First 8 years at EY, and then at Hurst since 2007. Nigel, over to you. So let
thanks,
everyone
Phil.
know what's been happening for you recently.
Sounds like I might be the biggest contributor to the 100 years, which is not a great position to be in. So I was just telling the guys before that unexpectedly we are participating in the ONS COVID survey, and in the last round of tests we had my partner, who was completely asymptomatic, tested positive. Fortunately, I don't seem to have caught it, but it has meant that this is my 10th day stuck in my little study. I've barely been outside, so I can't wait for tomorrow to get out and get some fresh air.
Brilliant. Thank you, Nigel. And last but not least, Oliver Hoffman, head of M&A at Mazars, 29 years in corporate finance, started at Coopers & Lybrand, PwC, and then onto EY, but the last 18 years at Mazars. Do you want to just give everyone a quick overview what's happening in your world at the minute?
Sure. Well, thanks, Phil. Like everyone else, sat at home, unfortunately in my kitchen and a little bit too close to the fridge, which is not good for my waistline. Alcohol level increasing too much as well. But I thought whilst I'm at home, I'll try and do different things. So over my shoulder, you'll see a Kenwood mixer. I thought I'd take up baking. So between regular Zoom and Teams calls, I make an occasional cake or a loaf of bread. Something a bit different.
Sounds good to me. Sounds good to me. Okay, yeah. So we'll start on the main set of questions. I'm going to go over to Oliver. Just tell us what's been happening at Mazars. How's the business responded to COVID-19?
Okay. Well, I guess our business, like all advisory business, it's really about two things: our team and our clients. And we spent the last 9 months or so communicating with both, keeping close to our clients to understand what was on their mind, what's driving their businesses, their challenges, and their opportunities as well. And there's been plenty of opportunities. And in terms of the team, reassuring, supporting, communicating, the level of communication within the business to our teams has increased massively. And I think that's made for a much closer and stronger business, which is really encouraging. And we'll take that forward into future years as well. So that's really our business. It's been about communication.
Thanks, Oliver. Nigel, how have Hurst responded to COVID-19?
Yeah, very similar to Oliver. I think our business as a whole, we're an accounting practice. We've actually found that initially it was a bit of gloom and doom, but actually we've seen clients, grab hold of opportunities and look to change their businesses. So we've actually, in a perverse kind of way, had quite a lot of enjoyment in terms of seeing clients get through this. We've battled through as well. So it's been very, very challenging, but actually I think it's going to prove to be a really interesting learning and ultimately rewarding experience for us all in a weird sort of way.
Thanks, Nigel. James, how have RSM been helping their clients through the COVID situation?
Yeah, so I suppose initially to the start of COVID, there was lots of webinars, talking around C-bills and furlough and all the new things that were kind of coming in, being announced. So making sure our clients are fully aware of the impact of these things and how to access funding, etc. That's continued, but probably less so as things have become a bit more stabilised. There's further announcements on furlough being communicated regularly, etc. So there's been lots of webinars and knowledge sharing, etc., to make sure that everyone's aware of the key risks and opportunities. And then I suppose we've also had lots of online roundtables alongside various sectors to make sure we're communicating about the people's businesses along the way as well. So, yeah, generally speaking, a lot to our clients, making sure we're aware of what the impact of COVID has been to their business to make sure that we can react and help them.
Thanks, James. And Roger, what about DSW? Have they been helping clients? And I suppose yours is a little bit different as well, because you've got certain equity stakes as well in some of the businesses.
Yeah, I mean that is the PhD equity partners in our early stage ventures business are separate in reality, really, to the advisory business in the sense that those are discrete equity investments within committed funds rather than an advisory client. But we are a bit different, I think, in the sense that we're not an audit and tax practice, so we are focused entirely around corporate finance themes, financial due diligence, and so on. So, like others, we immediately focused on clients and close connections. We didn't have that big sort of audit base, to make that a sprawling effort. It was fairly focused in terms of what we were doing and who we were talking to. As a business, we chose very deliberately not to try and monetize C-bill applications. So we gave advice and guidance to clients, and on the whole found their incumbent lenders very, very supportive, just as part and parcel of the relationship. In terms of the deal prospects, we like others, I'm sure, we had some technology related deals that kept on running, but quite a lot of things got put on hold or fell over in one form or another. And so what we were then focusing on in the subsequent months was some proper thought and planning as to how and when those deals could be picked up. Could they be renegotiated? Would they have to wait until 2021? And actually, we found the market has recovered very, very quickly in terms of funding, buyers, et cetera, So actually we find we've managed to get some of those processes up and running relatively quickly. So it was a combination of relationship support to ensure there was control and adequate capital, as well as actually some pragmatism around planning for rebooting deal processes or bringing projects online going into the early autumn.
Thanks, Roger. Nigel, over to you. I mean, what have you learnt in sort of 2020, and how will that impact how you approach M&A in 2021?
I think there's a couple of things to say there. I mean, the first thing is just a remarkable resilience and of a lot of great owner-managed businesses around the region, and this will actually prove to be a time when, if you're bold, there are opportunities. So both in terms of what people have done in their businesses to turn them around and do things differently, and so I think the big thing is just the fantastic spirit in the entrepreneurial base around the region and the opportunities that gives to us, and people find a way. I've actually stopped listening to the BBC because I just find it really frustrating about the overwhelming sort of negativity around the business world. Yes, there are pockets that are really problematic, but I actually think there's going to be a lot to learn from the way people have reacted to this. I think at the sort of prosaic kind of deal process level, we've got a deal closing in the next few days, and that will be the second one where nobody has met anybody. It's all been done remotely. We all knew the people before we started those deals, so that does make it easier. But actually, I think that remote working and the ability to have the video conference calls and people's kind of faith in those systems is actually making deals actually potentially more efficient. They can be done more quickly. And the avoidance of sort of all party meetings with 20 people sat around a table arguing and trying to make their point. I think we're getting to the point in a sort of crisper way. So actually, in a perverse way, I think everyone's learning to do things a little bit more efficiently, and hopefully that will when we all get back to physical meetings, we won't slip back into all of those old practices, because I don't think we need to.
Good. And Oliver, what are the learns from you that will impact how you do things in 2021?
So I'd echo a lot of what Nigel said, both in terms of client resilience. So I think all on this call would have some months ago predicted quite a damaging M&A market, but that hasn't happened. And that's been really positive. And it just proves that if people want to do stuff, it will happen. So I think one point is to worry less about what's happening, because if there's a will for someone to buy and a will for someone to sell, the rest is doable. So that's, I think, an important message in terms of resilience. And actually, this platform for communication works. It was perhaps a little confusing at first. We all still find ourselves muting ourselves accidentally, and that will continue, I think, forevermore. But it works. We can get deals done, and actually, there are so many things that I look back on that I've done in the past that can be done much more efficiently without travel. I don't mean that I don't want to get back into talking to people face to face, because I do, but actually there's a time for doing it, and there's a time when you can do it much quicker, much more efficiently, a different way. And that's the piece we need to take forward, both in terms of interaction with clients, but in terms of how we run our own businesses as well. Yeah,
that makes sense. Roger, quick question to you. I mean, how have you seen the sort of 2020 deal valuations? How have you seen that, and how are things currently?
Remarkably resilient, actually. I mean, I think in contrast to the financial crisis, one of the big differences here is that there are some very evident sectors which I'm sure we'll touch on that are very, very stressed, and I think if you put those sorts of those sectors and subsectors on one side, really, where there is just so much instability in earnings and so on, and look at the broader space in manufacturing and industrial services, business services, software, technology, etc., the trend lines are remarkably similar, actually, which was that the dip in valuations was, by normal sort of market indices and so on, was relatively short. I think broadly what was happening in those valuations were that multiples, actually earnings multiples, stabilized. Probably a mix of lower share prices and lower earnings creating the same kind of valuation multiples when you look at particular sectors. But as we've seen in the broader international stock markets, indices have recovered pretty well because valuations by definition should look forward and not backwards. They should be looking at the potential for recovery and into 2021 numbers. I think what's a little bit more subtle in valuations is actually what earnings are you multiplying? And clearly some businesses have had a big bounce, online retail and so on, a bit of a positive bounce from the COVID crisis, and others have had a dip and disruption. But I would say most of the market, buyers, funders and so on, are looking past that dip and they're looking at a more normalized level of earnings. And for some businesses, they have taken cost out permanently, and others have made capital investment, looked at new products, new markets, looked at a different strategy for a different environment, maybe taking advantage of shorter supply chain routes or whatever it may be. So actually, I think that whilst multiples have stabilized and strengthened, I think what's more interesting on valuations is what are the earnings you're looking at? What really are those pro forma and normalized earnings that are going to drive valuation of a deal? And I think trade and private equity markets are both fairly pragmatic in how they're doing that.
Thanks, Roger. And James, how have you seen valuations in 2020?
Yeah, I echo a lot of what Roger said there. I think at the start of the year, we were talking at the start of COVID, there was a bit of an impact on valuation, even in businesses are very robust, like with robust revenues, like software businesses. There was a slight dip just because of the potential risks associated with COVID and the long-term effects. But really in those markets, technology, software, healthcare related businesses, valuations have been resilient, if not gone slightly higher in the last couple of months as confidence has kind of come back. And as Roger said, there's private equity and trade are now in the market. So you're getting that strategic value coming through from trade in particular, and with private equity, they've quite a few private equity firms haven't necessarily invested as much as they'd like to because of what's happened. Therefore, if they see an opportunity now, they want to go for it, and therefore there's a lot of competition that increases the price. So, yeah, I think on the whole it's been very resilient, a lot more resilient than we first thought. I think with if you've got exposure to certain industries like retail, hospitality, which we'll come on to, I'm sure we'll come on to a bit later, then those businesses have been impacted, and therefore the valuations have come down. But on the whole, it's been very resilient, and we are seeing good valuations now. Will that continue into the year ahead? Hopefully. I mean, I think there's probably potentially an oversupply of opportunities in the market over the next few months. Private equity are going to have to be pick and choosy about what they take on. Going into next year, will they continue? Hopefully they will. There's no reason why they wouldn't do, because it's proven to be resilient this year. So,
thanks, James. And Oliver, question for you: how have you seen deal structures evolve in 2020?
So, deal structures really following what Roger and James have said about values, fairly stable, and that's probably changing though at the moment, and that is as a consequence of a big push for a number of private owners to sell prior to any potential capital tax changes in the budget in March. What that's meaning is to create a deal, to create a capital transaction. It's forcing some vendors to stretch perhaps structures in a different way, reflective of the fact that bank funding is not abundant at the moment. Banks are focusing on their problems and their core customer base. So that's changing deal structures to increase a level of component of deferred consideration or greater level of vendor share capital in a transaction. That's very current and will carries into the first couple of months of next year. But post whatever comes in a budget, I think we'll return to more traditional deal structures.
Thanks, Oliver. Nigel, how are you seeing?
I mean, just to add that what in a way surprisingly normal, you know, given where we've been. But I've noticed we're mostly advising owner managers, and I've noticed that they are partly, I think, because of the tax, but also just because of the long term, you know, sort of prognosis for things, is perhaps more of a focus on just getting as much cash out as possible at the expense of, you know, retained equity or deferred consideration. So actually willing to take a lower headline price with more cash, just so they've got certainty. Perhaps the only discernible trend, really.
Thanks, Nigel. And James touched upon something Oliver said about the potential changes to capital gains tax. Are you seeing that having any effect on M&A at the minute?
Yeah, definitely. I think, you know, there's a potential for tax rates to go up in the budget. I think people have been looking at that as to be middle of March was the date originally for the people thinking the budget was going to be. I think now they've said it's going to be the 3rd of March, which is, you know, if you start in processes now, you're in process, you've got to be quite advanced to be hitting those timelines, really. So that's, you know, that extra 2 weeks that we thought we had maybe is now probably potentially not there. Capital gains may not go up. We don't know whether it will do. The Office for Tax Simplification have sort of recommended it maybe equalises with income tax, but, you know, will that be for all businesses, all business owners who are entrepreneurial business owners that want to drive growth? Well, that might actually stem entrepreneurial spirit in the UK. So, you know, no one really knows whether it's going to increase or not, but there is a risk, and therefore with that, if people are thinking of selling, they want to try and get it done before that date if they can. So I suppose we've been working with quite a few businesses that we were thinking of, you know, launching next year, but we've brought that forward to this year to try and get it done before the tax year end. So yeah, it's you know, this isn't a normal Christmas for advisors. We're normally out socialising and having a good time, but now it's just very, very busy because of that. So I think it is driving growth. It's not the only reason why people are selling, because it is a good time in terms of valuation, etc. But it is certainly a big factor that people are thinking maybe accelerating their timelines.
Thanks, James. And Roger, your side of the Pennines, are you seeing anything similar over there?
But yeah, very similar, and I think it probably generated quite a lot of activity in the market in terms of new appointments and so on towards the end of the summer and early autumn. I think that those that were concerned about it, you know, got out of the gates early in terms of prepping up a process. I think when you look at tax clearances taking anywhere from sort of 4 to 8 weeks, really at the minute, there isn't a lot of time to do something from a standing start, and the Chancellor was quite smart, if that's the right word, in the 11th of March, changes to entrepreneurs relief and putting in various anti-avoidance measures which stop people fudging a deal and trying to get it over the line and beat the tax increase. So I think our experience is really a little bit of a gentle press on the accelerator to try and make sure things get done now by the end of February where they can be. But if anybody's trying to do something from a standing start, I think that's quite a challenge. I think it will be very, very detrimental to the owner-managed market if it's a really big hike, because CGT is a voluntary tax at the end of the day. I think if it isn't matched with some creativity on entrepreneurs relief to reward genuine long-term business builders, I think that will be a very bad thing for the economy generally. And for the deal market, I think it'll just put things on hold whilst everybody soaks it up and gets used to the higher rates. We'll spend our time doing growth cap deals and acquisitions probably, but I'm hoping there's going to be some sanity on whatever changes are coming.
Thanks, Roger. Nigel, COVID aside, the B word obviously on the agenda at the minute. Do you think the prospect of a hard Brexit and how that might impact foreign exchange rates could have an impact on A, the economy, and B, sort of M&A?
Yeah, I do really appreciate you asking that question, Phil. I've got to say, personally, I think the most important thing about Brexit is it's sorted one way or another. Actually, the uncertainty is probably worse than whatever the outcome might be. So I do hope that we get a resolution, whatever that resolution is, and then we can sort of get on and plan around it. Outside of Hurst, I'm actually a non-exec director of two businesses. One of which is an £80 million turnover food ingredients importing business, and there are some quite scary tariffs if we fall out of the EU with a no deal and we go down the WTO route. So I do really hope that we do find a deal. But if the worst happens, then yeah, there are going to be certain industries which will have some quite nasty tariffs to deal with, probably in the short term. But as I said, in terms of COVID, people find a way through. So I think there will be certain sectors that probably won't maybe find it as easy to do M&A if there is a hard Brexit. But ultimately, entrepreneurs will find a way. As I said, I think the best thing is it's just settled one way or another, and then we know what we're dealing with.
Thanks, Nigel. Oliver, what about you? What's your thoughts on it?
I tried to read what the foreign exchange markets are saying, and they're notoriously unreliable, but at the moment they're saying there's going to be a soft Brexit, and if that's the case, there's just a lot of posturing. And actually, if you look at what's being talked about, which is fisheries, it's an absolutely tiny fraction of the economy, but very, very public in terms of profile. So I think there's a likelihood, despite what's being said, of a deal being agreed, but it comes like all political things late in the day. There's been so much confusion and perhaps not the best communication as to what the consequences are, and it will cause, whatever happens, some ruffles. But I think those are going to be short term, because markets correct, and they correct very quickly. Pricing corrects, exchange rates correct, and businesses find their feet. So whatever the outcome, I don't think there's going to be a long-term consequence. But I think to most people in business, clarity and the status quo in terms of exchange rates and tariffs are preferred.
Yeah, well, hopefully we'll get that clarity soon, but you never know. Roger, I mean, question for you: would you say is now a good time to make acquisitions?
I think it's generally always a good time to do acquisitions if a business has real growth ambition and it's got the capital behind it. There's probably a few drivers out there at the minute which mean that there is a supply of those targets. We talked about the CGT changes, so that there'll be businesses that are midway through process for one form or another to try and sell and crystallize those tax liabilities at a lower rate. So there's a supply. The distress side will come as businesses need to be rescued by larger groups, so that there's potentially those sort of asset or distressed valuation type deals that are available. But I'd also say looking at the financial backing aspect, the private equity market is generally very positive towards buy and build strategies. Growth cap investors as well. And one theme that came out certainly through the earlier months of the COVID crisis was a sense from the private equity community that they really wanted to push on those strategies because they saw them as lower risk, and do see them as lower risk. They're backing the existing management team to acquire a business in a sector that they know. Buy and build in portfolio became quite a strong theme through the summer. So I think the capital's there to do it. I think the supply of targets is there. That might change after the 3rd of March in some areas of the market. And I think we'll see some distressed M&A in the new year, which will be an opportunity for those that have got that kind of appetite. So I think for those reasons, if there's a growth aspiration, then certainly that environment continues to be pretty strong.
Thanks, Roger. James, your thoughts on whether now is a good time for acquisitions?
Yeah. So yeah, I mean, we're corporate finance people, so we'll always say yes to that. But I think Generally, yes. I suppose there's got to be a reason for an acquisition, as well as just kind of growing EBITDA and revenue. There's got to be a reason really for it. So is it going into a new market, a new sector, acquiring new capability, a new skill set, or a geographic footprint? So there's got to be a reason for it. So if there's a specific reason for it, there's always a good reason to do the acquisition, as long as the value and the deal structure is sensible. I think, as Roger said, going forward, there might be some more distressed opportunities around. I think going back 6 months ago, we probably thought it would be around this time, but because of the extension of furlough, the extension of CBILS, that's probably going to be going into next year, or certainly going into next year and maybe middle of the year, perhaps. And so, care needs to be given about the timing of any acquisition as to whether actually you might be better actually to wait to pick up any and be opportunistic at that time, because we do anticipate, but no one really knows that there's going to be quite a lot of distressed activity next year.
Thanks, James. And Oliver, what would your advice be to any sort of owner managers or owner managed businesses that are thinking of selling in 2021?
So some of it's really the reverse of what James and Roger have just said, because we're talking about selling this time, and that there's a market for selling in the same way that there's a market for buying. My advice would be, do what's right for you when it's right for you. That's always the case, and it's always helpful to have a real close eye on what's happening in the market from the buy side. And there's plenty of money around. There's money both sat in corporate pockets, in private equity pockets, but that money is pointing in certain directions, and it's pointing in directions at certain sectors and also at the quality end of the market. So if I were an owner of a business, or if I were advising an owner of a business, I'd be saying, if you've got a business that's in a sector that's in demand, if you've got the protections that a buyer likes to see in a business, which are barriers to entry, good management team, defensibility of future income generation, that 2021 will be a good year like any other to look at sale. But if a number of those points or too many of those points aren't there, I'd be advising a client to work on some of those to get the business in a better shape for sale a year, 18 months later.
Thanks, Oliver. And Nigel, any other advice you'd give to owner managers?
I think Oliver's got it spot on. I mean, there will be a temptation, certain sectors, healthcare, IT, which we mentioned before, where valuations are definitely creeping upwards. And I guess if you're kind of nearly ready and you're in good shape, from your business is well organised, it probably is a good idea to maybe advance plans. But if you're a more prosaic business where you need to do that building and getting those hygiene factors right, then don't get distracted.
Thanks, Nigel. And James, looking at sort of other sectors like leisure, travel, hospitality that have maybe been affected, how will they be impacted from an M&A perspective when things get back to normal?
Yeah, so it's been a really tough year, hasn't it, for businesses in that sector. Often been shut down or for long periods. It's been incredibly tough, and there's been a lot of CVAs in that market. Certainly, we've been involved in a few, the likes of Gusto, etc. I think, going forward, there's a lot of these businesses will, I would imagine, have kind of deferred their VAT, deferred rents, etc. So I would anticipate there's a long period of repairing balance sheets. So that might be, additional funding or maybe some equity into the businesses once things have settled down. But any investor would need a long period of a track record to make sure that there's they're not there's a sustainable business model there. Ultimately, the strongest, so if you look at hospitality, there's a lot of restaurant groups pre-COVID weren't really making that much money in the first place, to be fair. So there was a bit of a challenge in those sectors already. There will be some winners and losers in this next year, and the strongest businesses will come out of it actually potentially in better condition longer term, in the medium to longer term. So I think for me, it'd be a case of repairing balance sheets, certainly in the sector, and there might be a bit more restructuring to be done before any kind of real M&A activity comes into the market, because there needs to be a longer period of sustainable track record of performance really for that. So that answers your question. I think there's some positive news, like there's a we floated a business on AIM called Various Eateries PLC to roll out their businesses across the UK, but also for acquisitions. So it's not all bad news, but it's been definitely been a tough year.
Thanks, James. Roger, anything to add on that?
Yeah, just a couple of points. I think this whole crisis, as many situations like this do, they accelerate certain behaviours, and certainly they've changed consumer behaviour, and in some areas probably permanently. So I think it's a horrendously sort of polarised crisis in terms of the sectors that it's impacted. And without sounding sort of complacent about it or like some kind of art critic, I think businesses have to be realistic. If they need restructured and they need some kind of white knight to kind of rescue them as part of that, then that should be considered. It's all about sort of maintaining control as a business owner. And I think for others, they might just have to look more aggressively at sort of changing their business model to be different and potentially look for the right kind of investment for that. I know one of the ideas that's been sort of mooted in this sector is whether there should be looser rules around EIS and VCT investments, so that there's actually some tax incentive for people to get in and try and support the recovery of the sector and the change within it. So I think when we get into calmer waters, I'd hope there's a more sort of strategic kind of look at this whole space from government and the funding market, so that those businesses that should be saved can be saved.
Thanks, Roger. And Nigel, how do you view sort of valuations over the next 12 months or so? How do you think they'll be affected?
I think we've got a kind of dichotomy, really. If you've got a business that's in sectors that everyone wants to be in, healthcare, IT, we mentioned before, but also, I spoke to one of the PE house recently, and they were saying, any business that has got through COVID kind of no growth, that's pretty positive. So there will be certain businesses where, particularly if private equity community is interested in, valuations are definitely on the up. Whereas there are certain businesses that you almost can't give away. So we have got it's the first time in my career I can remember where there's such a disparity between the positive and the negative. And I would expect those trends to continue. We're going to talk later about the whole world of private equity, but there's so much money there, and the range of transactions that they want to do, or the range of sectors they want to invest in, has narrowed considerably. So businesses in those areas, I think valuations will continue to increase during 2021, whereas I would expect that other sectors will continue to be pretty difficult for the rest of the year.
Thanks, Nigel. Just as a reminder for the listeners, if you do want to put a question to the panelists, we'll be going through those shortly. Just use the chat box at the bottom of the screen, and that's what we'll use to have a look at any potential questions. So just moving it on, over to you, Roger. Do you think there's going to be a increase in carve-outs from larger groups sort of in the next sort of few months and throughout the course of next year?
Yeah, I think that some of that has been happening already. I think there's been a number of transactions around the country where there've been corporate divestments. I think we talk a lot about owner managers and so on. Why do big groups sell? Well, I think sometimes that they'll do that to reallocate capital into areas of the market where they want to be. So I think that sort of strategic reorientation is something that gets accelerated in this kind of climate when capital is perhaps sort of seen as scarce. I think the other aspect really is some of that reassessment of strategy more generally, and there'll be a lot of boardrooms debating whether they have certain subsidies and so on that are just not in the areas of the market that they want to be. And I think the other third aspect I mentioned really is in a climate like this where you're in a crisis, a bit like putting bad news out in a crisis. I think if a group needs to do a little bit of tidying up, and the capital is out there from private equity or whoever to back these sorts of carve-out deals, then it's not a bad time just to streamline the group and really put some focus on the core areas. So I think probably the volumes of those types of deals will have crept up during 2020, and I think we'll see more of it in 2021.
Thanks, Roger. Oliver, just a sort of quick question to you on something we touched upon earlier about distressed sales. I mean, do you think we're going to see a higher proportion of distressed sales as we move through 2021, as sort of things start to catch up on certain businesses? What's your thoughts?
I think the market's expecting to see quite a big jump in distressed M&A and corporate restructuring situations as well in 2021. I'm not convinced that's actually going to happen, and that's because government support has continued a lot longer than it was introduced to do so. I think it was yesterday or the day before that furlough was extended a further month. I don't think the government will allow that situation to happen. So I can see a greater level of distressed M&A than this year, partly because it's been quite low this year, but not in any form of spike. I don't see that happening until perhaps the back end of 2021 or into 2022, when literally the taps absolutely have to be turned off because there's no cash left to fund business on a permanent basis. So at some point, but not as early as the market might be expecting.
Thanks, Oliver. Nigel, your thoughts on that?
Yeah, I would agree. I think certainly if I was a corporate buyer, I'd be extremely wary about doing any distressed M&A right now, because for some businesses and some sectors, where is the bottom of the market, and people can CBILS is still open till the end of March. VAT deferrals can be renegotiated for another extended over another 12 months. So there's plenty of government support, and talking to the insolvency community, there's a lot of advice around, but there's not a lot of formal instructions of businesses approaching receivership. So I think businesses are going to be able to stay afloat, on those sorts of aid packages for a while yet.
Thanks, Nigel. And James, I'm going to put a question to you about sort of bank funding. Do you think they're going to continue to fund deals?
So I suppose in terms of this year, we've seen that the banks have kind of reopened again after mainly focus on CBILS for the first few months of the COVID period. But in the last few months have opened up, particularly around the sort of challenger bank. The debt fund market has been very competitive. We've seen good levels of leverage put into transactions that we're working alongside private equity. So that's where we've seen most of the activity at the independent sort of debt fund level, challenger bank level. Will that continue? There's a lot of, certainly on the debt fund side, there's a lot of money still around. So yeah, we'd like to think that'll continue going forward. Will Brexit start to come on the agenda of banks, next year probably? But yeah, I think on the whole, the debt funds, the challenger banks, we expect to remain active next year.
Thanks, James. And Nigel, question to you. I mean, do you think the appetite for PE is going to continue into 2021?
I think the sort of macroeconomics, if you will, are still very strong. There's a lot of money in private equity. Interest rates are at 0.1%. There's no money to be gained from pension funds putting money anywhere in sort of or not taking it away from PE. So I think the trend will continue. There's a lot of highly paid people whose jobs depend on them making those investments. I think someone made the point before that it is easier for the PE guys to back an existing portfolio company. So, buy and build activity driven by PE, is where they probably prefer to invest rather than start from scratch. But if you're in those sectors that I talked about before, you're hearing stories of, people going to market with those sorts of businesses, and, there's 20, 30 people all prepared to pay aggressive high prices. And there will be a few funds who are perhaps over overexposed to, leisure, more difficult sectors, and they might find it more difficult. But across the piece, I would expect the whole private equity market to be a big driver of activity throughout 2021 and beyond.
Roger, I'm going to ask you this one. What's the outlook for sort of early stage businesses? Is there startup capital and venture finance available there?
Yeah, I mean, I think we distinguish really between businesses that are kind of in revenue and looking for venture finance as opposed to pure startups. Startups are always a tough area of the market, and there's some tax incentives to invest in those. But really, where the oversupply of capital is and has been for some years is really in the venture finance market. So when a business is getting up towards, $750,000, $1 million of revenues, maybe making losses, looking for that scale up capital. The money that's flowed into the VCT market has been pretty eye-watering over recent years as pension tax relief has been pulled back and individuals have put money into those tax-efficient structures, albeit for higher risk. It's an interesting sort of connection or other side of the coin or whatever to the whole CGT and entrepreneurs debate, because there's significant tax incentives for individuals to invest in early stage businesses through VCT and EIS funds. But yet they've pulled back the incentive to entrepreneurs that are actually building the businesses from within. And maybe they'll do worse in March, who knows? So there's a lot of capital there, and those funders, the venture capital trusts, particularly in the early stage funders, are competing with trade buyers and bigger private equity backed groups and buy and build strategies in areas of the technology and niche specialist service markets, and in some cases paying eye-watering valuations. So that is a very buoyant part of the market. And I would say any business that's getting up towards $1 million of revenues, if they've got a decent business model, they're probably pushing on a very, very open door.
Thanks, Roger. James, any thoughts on that?
Yeah, there's a lot of VC, AS money around UK and international, and there's a lot of, as I think Roger was alluding to there, there's a lot of corporate venturing companies as well. Investment kind of from corporate venture companies probably was slightly lower at the start of COVID, but that's really come back on in the last few months. So we've got multiple sources of funding into early stage businesses. We're working on a couple of niche sectors like additive manufacturing, and the valuations that are in that market at the moment are huge, and that's driven by the growth potential in that market, but also the level of appetite from investors. So I think quite a few businesses in early stage businesses have also benefited from the Future Fund with matched funding. So that's really helped some businesses kind of cope with the COVID downturn, if they've been impacted. But as Roger said, if you've got a good business model, there's a lot of funding around, and the valuations are significant. We don't expect that to really reduce going forward.
Thanks, James. So I'm going to just have a look at any of the audience questions. I think some of them have been covered off already, but one from Steve, which is all about the sort of structures. Are you seeing more earn-out structures given potential EBITDA volatility over the past 12 months? Who wants that one? Who wants to jump in on that one?
I mean, I was saying before, I haven't actually seen big changes in structures. I think the big thing around EBITDA, this year is trying to demonstrate how what the impact of COVID has actually been. So to me, it's more about trying to prove what EBITDA actually is, rather than a fundamental change in structure. So what we've been trying to do when we're talking to buyers is say, this is what it looked like pre-COVID. These are the cost reduction measures. These are the rationalizations that the business has been able to introduce. And this is the evidence of post-lockdown trading to try and get to an EBITDA position where you can, get the valuation that you want now rather than having to rely on an earn-out.
Thank you. This question is picking up on some of Roger's earlier comments on normalising earnings. So I'll put it to you, Roger. Have you found that Q of E has become a bigger area of risk this year?
Q of E. Just explain that.
Quality of earnings, is it? Quality.
Yeah, I think so.
Quality of earnings. Okay,
Yeah.
Quantitative easing there, or quality of
that's come from Jeff. He's trying to trip you up, I think.
Yeah, I mean, every situation is a little bit different, but I guess what we've found is that trade parties and private equity parties are quite willing to look across, a few months of lockdown and a few months of significant disruption, and we're in a one of my lights has gone off. We're in an environment now where those businesses have got a few months of trading behind them. I think the banks are a little way behind that. I think they're looking for a few more months. So in some cases you can kind of smooth over that dent quite easily just by saying, look, the 2-month period of lockdown or 2-month period of disruption, and that's relatively straightforward. It's a little bit more tricky when you've got a business that is still got supply chain issues or disruption in the market, or indeed is sort of trading way ahead of budget because of different dynamics in the market. And that's where you might be creeping into more of those sorts of earn-out territories. So I think some businesses it's relatively straightforward given where we are now at the end of 2020. I think sometimes there's a little bit more to unpick, and as I mentioned earlier, I think for a lot of businesses they're actually shifting their product, market, supply chain, capex spend, whatever else. And so actually quality of earnings is one thing, but actually some kind of pro forma earnings is another question. If actually you're trying to demonstrate the earnings potential of some of the strategic decisions that have been made over the last few months, but are still waiting to flow through the P&L. So I think if we can avoid a kind of third wave and a really protracted start to 2021, I think we're getting to a stage where there's more normality in most businesses' earnings profile to allow deals to be properly measured and struck.
Thanks, Roger. Okay, one last question that I'm going to focus on before we start to wrap up. So this one is on listings, and stating the market for new listings has been subdued since mid-2019. How do the panelists see appetite from institutional investors for new listings either on AIM or the main market during 2021? Who fancies that one?
I don't mind taking that one.
Okay, James.
Yeah, I mean, I think we've part of our business we have a capital markets team, so I suppose just looking at how busy they've been in the past sort of 6 months or so, they've been really busy actually. The market has opened up, and there have been some new flotations, IPOs, etc. I mean, one big one is we'll most be aware of is the Hook Group, and so that's significant flotation in the recent times. So actually, there's been a lot of uncertainty in the market, but actually the capital markets have been open for the right business. And I mentioned before, we were involved in floating a restaurant business, so that shows that there's still a lot of appetite around. So yeah, I think what certainly was subdued 2019. I think there's actually been quite a bit of activity this year, and will that continue going forward? I suppose it depends on the economic outlook. Very very kind of sometimes they're open or closed within a few months generally. So for new IPOs, but yeah, generally speaking, it's been very active in recent times. So no reason why that won't continue.
Thanks, James. I know everyone's got sort of meetings to dash off to at 2ish, so we'll leave the questions there. If anyone wants to reach out to the panelists, then everyone is on LinkedIn. They've said that that's fine if you do want to reach out, and continue any discussions, then they're available on LinkedIn. A massive thank you to the panelists today. A big thank you to everyone that has signed up. I hope that you interact with FD Recruit or the Exec Recruit group in one way or another in the next months, and it'd be good to keep in touch with everyone. So a massive thank you to everyone that signed up. Stay tuned for webinars in 2021. I want to take the opportunity to wish everyone a Merry Christmas. I know the M&A guys might not get as much time off as they normally would, but listen, thanks again, and I'd like to formally bring the session to a close. Cheers, everyone.
Thank you, Phil.
Thank you.
Thank you.
Bye-bye.